All right, so this is the Market Structure Edge demo for November 3rd, 2022, and I'm going to share my desktop. And if you're new, I'm Tim Quast, and thank you for joining us. Nice to have you veterans back. Oh, I always enjoy that. It's good to have you here and to hear how you are using the platform. I get notes from you all the time, and keep those coming. Always like to get feedback, good and bad. I mean, there's a lot of good feedback. I have people who say, "Man, I just got killed." I'll look at the data and see why, but it's easy it's easy. Nobody's perfect. I make mistakes periodically too, and it will happen. But I can tell you that generally, I've been very, very pleased again with what the data has done for us. Hope it is working for you. I will mention some of that because I think repetition is a good form of emphasis, and it's nice to be reminded that if you follow these things, they work pretty well. So let's hey, Najee's here. All right. Okay. Hey, Najee, welcome. We're just getting started. Just getting started. And he said, let's let Richard back in. I hope it works this time. Okay. I may have to do that periodically. So once again, and I know, Timothy, I didn't see if you're here, but thus far, my effort to know exactly what I'm going to say far enough in advance that I could put it in the meeting invite has failed. But it doesn't mean I won't try to do that. But I do have a number of things to cover. Basically, I have 5 things again that I would like to go through, and just interrupt me at any point if you're new to these. There are only 2 rules: mute yourself while we're talking, but unmute at any time and ask a question. A lot of the value here is our interaction. So fire away, ask questions, make observations, and we'll do as much of that as we can. So I want to start here. It's again a reminder. If we look at broad sentiment, it's been a great, to me, it's not perfect, but it's a very good indicator of what's likely to happen. So if you're new, this part of the graph here, this is SPY, the price of the ETF that tracks the S&P 500 is supposed to. I mean, the variances have been crazy here lately. Not sure what that means. I think it means that contracts for difference, derivatives, swaps are very difficult to properly price, and somebody's winning and somebody's losing on those. This part of the graph that's demand, an algorithm on a 10-point scale that meters buying and selling by investors and traders. And it's a math based on trade execution rules. And when it's over 6, the market tends to be near a top. When it drops below 4, tends to be near a bottom. And those short-term trends change all the time, and it's because of the nature of money. There are people who bet short-term. There are index funds, ETFs, exchange-traded funds, quants, who will have to true up their tracking, and they tend to. So money comes in, new month, new money. By the middle of the month, around options expirations, they need to get a little square. By the end of the month, they should be tracking the measure. They don't always do that, but those create a cadence, and it means that if you're overweight one thing, you get rid of that and you reweight to stuff that you're underweight relative to the model, and that creates a flavor to the market that you can take advantage of. If those conditions did not exist and rules didn't require everybody to trade between the best bid to buy and offer to sell, which will never be the same, this math would not be possible. But it's because of those conditions that it is. So here's where we are lately. Options expired right here around, call it October 20. The little green squares at least tell us what happened there. And so often those are turning points. If the market is down into options expirations, it tends to recover afterward, and vice versa. We had month-end futures contracts expire on the 31st on Halloween, and the market is way up here, extremely hot. Here's the supply side of the market. That's short volume. Let me do this one more time. John made it. That's good. And this is what Barry was talking about, that the supply side, if you look at here's broad market supply, which is short volume. And I get questions about, is that really a good measure of supply? I think it's a great measure of supply because it seems to work very well. We understand why short volume, which is borrowed stock, is a good measure of the supply chain of the stock market. It's because post Dodd-Frank, important legislation, post regulation national market system, which came 2 years before that, roughly 3 years before implementation for Dodd-Frank, that the big brokers who used to carry inventory and supply it greatly reduced that activity because of regulatory couldn't carry value at risk at the rate that they could before. And then Reg MS creates a market where it's a continuous auction. Well, you can't have everything for sale all the time without having some of it become artificial. And so market makers are exempted from when they're engaged in bona fide market making, say I'm buying and selling. They don't have to locate shares to short. So it becomes a very good indicator of supply chain. When it's very high, there's a great risk that the market will fall. When it bottoms and demand increases, there's a strong probability that the market rises. And it clearly, as demand has run up and supply has run down, we have seen very nice performance, particularly in blue chips. But those conditions, when they reverse, just as we do with individual stocks, we know that probably the market declines, and it can be ahead, a little bit ahead, a little bit behind. Fed meetings can have an effect because of the derivatives that people use as hedges. If interest rates move or currencies move, particularly the latter, it will change outcomes, and that will contribute to the move that we saw yesterday in the market. But you look at this and you say, what is likely to happen next in the short term? Well, it's probable. It's not absolute, but it's probable that demand begins to decline and supply begins to rise. That is the usual outcome from this current condition. And if you went all the way back in the data set to say, well, can we have some read on what to expect? The reason the data go back to about July 2017 is before that we didn't have this is the data measured exactly the same way objectively all the time. Before that, it was spotty. There wasn't great data for the broad market. So this is what we use. But when the market is spending a lot of time between the green and red lines, when the average is about 5.5, the market tends to do very well. When that breaks down, the market tends to falter, and there's cause and effect. It may not be immediate. I go back and say that in about, call it, April, May of 2021 is when the momentum market ended, because we stopped doing that, and we started to drag just a little bit below 5.5, and that was the point where you could be prepared for a shift from value to growth. And now look at it. I mean, it's really these are extreme moves. They're a lot like we saw back here. So you get momentum, but is it sustainable? I don't know. I would look at the trend in supply for part of the answer there. There's the economic realities, and then there's market structure. I look at this, and while it came steeply down, contributing to a very nice run for the market there, that those levels remain very high. If demand does not return to levels that we saw back here when it was helped by a lot of excess money, then the probability is that the excess supply in the market will cause the market to resume a downside propensity. I'm not saying that's going to happen, but I would look at that data and say, well, it's a risk. So, that's part point one and part point four that I wanted to talk about, but I think it's a helpful measure. It doesn't really change what we do as traders. I think it should help you modulate maybe your longer term money. If you know that these conditions are likely to mean lesser returns in equities, then maybe you want less exposure to it. When you know that there's excess demand and insufficient supply, and we had a period there where it was very good. And here's this period. The whole period where the post-pandemic period, we had insufficient supply and very strong demand. And then ultimately demand slowed and supply rose, and the market it didn't fall apart, but it's certainly taken a beating. NASDAQ down 35% or so. So that is, I just show you that to say, well, there's not you can't look at it and draw an absolute certainty about what will happen. but you have a pretty good idea that we can probably trade momentum regularly here, diverging supply and demand, but that the equity market is going to probably struggle some more. That's what those data to me would suggest. So observations, comments, I mean, you guys are smart folks. So if you have other thoughts, feel free to interject them. Okay. But the next thing, and again, ask questions if you got them. And
Okay, Tim, I have a question, if I may.
absolutely,
It's
Alexis,
nice to
fire
meet you.
away.
First time we speak. I'm from St. Bart, so when you wrote the articles earlier last year, when you went there, I was smiling because that's where I grew up. Um,
That's that
anyway,
is that is great. Well, I have a funny little tidbit. Wait, so we were in St. Bart's, and we're walking down the street, the main drag there,
yeah.
and I look over and there's a Moots bicycle sitting there. And so, I'm a big bike guy. I like to cycle, ride road bikes.
Yeah.
And it's those are made in Steamboat Springs. My good friend Brent Whittington owns the company
Uh-huh.
there. And a guy came out and I said, "Is this yours? This Moots?" I said, "This, world famous custom made bike." And he said, "Yeah." And he said, "I'm having trouble with it." And I tuned his bike right there so that he could shift gears. So that's my St. Bart story. Sorry, Alexis, go for it.
That's quite all right. So I started shorting the market in mid-August after the long run-up since the June
Okay.
lows.
Okay.
And unfortunately, I got out on the 16th, which would have been, so
Options expirations.
I
Just
made a
right.
little bit of money there, but it
Yep.
was the very first leg down of many, many to come. So anyway, I've learned my lesson. However, looking back at market structure, the supply reached the bottom around the 14th of August. And so I'm still trying to really understand the relationship with supply and more, and price behavior, where a very low supply would have suggested a rise in prices. But maybe because it was so low, it was also suggesting an upward trend in supply, where now the increased supply, and it went up from there. If you look at the supply of the broad market,
Yep.
August 14th would have, so strictly looking at supply, you would have thought, hey, there's no supply in the market, so there's going to be an upward pressure on price. And in fact, it was all the opposite for the weeks to come. So I just wanted your take on that. Was that an exception, or was it because we were so low that we should have expected it to go back up at some point?
No, it did. It did exactly what the data indicated. Here's the thing. So
Okay.
so here's when you left, which is wisely right before options expirations. Those little
Yeah, but I
those
was
little
short
green.
actually, so I left way too soon. I was
Okay.
shorting the
Oh, yeah.
market.
Oh, okay. Okay. Well, okay. Here's your great short lesson then. So that you're exactly right. The supply side bottomed at options expirations. Demand was way over the red line. So we had diverging demand and supply. So
Hmm.
the demand rose and supply fell. And then demand stopped rising, but it's way over the red line. So the probability of sustainable gains is very low. The only thing that was producing gains there was falling supply. Then they both reversed. And that is the condition that will cause the market to go down. This is what I use to sell individual stocks. Right? If I want to buy them with, I'm long, not short, but the reverse would be true. So I want to buy rising demand and divergent falling supply. That condition tends to produce gains, as one of our users, Barry Bailey, pointed out. In almost every stock that has those conditions that we've highlighted, in 4 days, they have done very well. I always say, it's somewhere between 3 and 5 days. So the
Hmm.
reason the market fell here is those conditions reversed. Supply began to explode and demand faltered, and down the market went. And it didn't recover until those conditions reversed again. See this? So supply peaked up here at 53%. Horrible. That sent us to a new low for the year. Then those levels reverse. So supply begins to fall, falls below trend, demand picks up, and the market takes off. And we had an awesome October. So it did exactly what you would expect. So you want to short at these points, particularly as it drops back, if the market's falling and it drops below 5 and supply jumps, great time to short the market, and don't get discouraged, right? You want to, until those conditions reverse, your short will work, even if the market goes up for a little bit, like it did here. That, because don't trade price. Price will trick you. Price will drive you to madness. But if you trust that the supply demand equation will help you, you will know that these conditions are very likely. Even though the market recovered here, supply was so extreme, it was not possible for that to hold. And sure enough, the market then went down. So that's what you want to do when you short. And I'll say again that the condition you're looking for to increase that probability is insufficient demand that I think drops mathematically. We've changed our view a little bit about this. We used to say, well, when it's coming off of a 10 and it begins to decline and supply rises, the price is likely to stall or fall. But the better opportunities on the short side are when demand drops below 5. Now you have you have more supply than demand, even taking the supply side out of the equation. And then with supply rising, if it's more than half of the trading volume, it's not impossible, but it's extremely difficult for those stocks mathematically to rise, because there's the supply demand balance is all wrong, and that's what you want to short.
And so, in essence, if you see a super low supply, you can, because it really peaked on the 16th, but on the 16th on the supply side, I'm still looking at very low supply, but then it started going up from there.
Right.
And
right.
so is it also actually, like an extremely low supply could indicate a rise in supply subsequent to that sort of unusual low?
Exactly.
So yes. That was can I cut in? That was a very
Please.
Unique time, and it's a classic encyclopedia example of market structure, because that was over a weekend. So on the 18th, we actually saw a bottom in supply. Then on the 19th is when supply started to kick up, and that's when price was already coming down, but sentiment was going up. So 2 out of the 3 were just screaming, "Hey, we're going down." Typically, what I've found is that if I just follow supply, and when I see that steep downdraft in supply into mid-August, and then we finally get the tick up, even with individual stocks, that is a great signal to get short. And in this particular instance, premiums were still, volatility hadn't kicked up because the market went from 426 only down to 422. So it was still effectively sideways.
Right.
So the market makers hadn't started to hedge yet. We had a day to get in and get set before the waterfall came.
That's it. That's a good explanation.
Okay, well, thank you very much.
Yeah, absolutely. And it takes time. Alexis, I think it takes some time and practice, and I'm sure Barry will tell you the same thing. I had this exchange with a user who kind of threw the whole kitchen sink at a trade, but without yet understanding what to do, and that's dangerous. It takes some time to learn. Once you get comfortable, it's very effective, and I'll give you some more examples.
Yeah, the hardest thing in the world is to sit there on day 1 and have day 2 and day 3 go against you, and then day 4, 5, and 6, it's like you're in your happy dance.
Yeah, exactly. I have to do that all the time. Just wait. As long as the math is telling you that things are going to work out, most of the time they do. I could give you examples of both. Okay, so some things about earnings very quickly, because 1,000 companies reported or will report results today. And I just want to hit some of these things because if hedge funds love to trade around earnings. They produce, call it 2/3 of their returns. And I'm going on what the major hedge funds have told me. But here's what you can, if you want to do that. And I'm not one of those who tends to do this, but you could look at, for instance, here's Uber. How would we know what Uber is likely to do? Well, you're not going to see bets show up in demand. Bets will only show up in supply. Bets are a right, but not an obligation to do something. So if a hedge fund bets with, let's say some form of long instrument like call options or a total return swap or something like that, there's a probability that that will manifest in the supply side of the market, much more so than the demand. So here's Uber right ahead of results. So demand was starting to come down, but look at this big deficit on the supply side. That tells us that the bets are long. You'll almost always see that to be the case. So we don't even have to know what's going on. We have a pretty good sense that hedge funds have bet long. Now they are wrong on occasion too. Let me let this person in, but it's a pretty good way to know that the bets are long. In this case, on Uber, that the expectation is Uber's going to rise. Now you know that if you capture that, then immediately leave, because you know the demand side is falling. So this will be a short-term event that came from long bets, and the parties who are on the other side were probably forced they had to buy in. They had to cover those positions, and that drives the stock up, and you should be out with that. But it's a really nice way to know that opportunity exists. Now, on the flip side, the reason it's dangerous, I just want to use a couple of these examples. The outcomes like this are also possible. This is the risk with doing that. It's pretty apparent to me that there were short bets with a longer duration set at right after options expirations in October in Edwards Life Sciences, and then there were long bets. And that's the risk, because you could look at that and say, wow, that's a really nice divergence. Demand's rising, supply plunged right ahead of results, and it got destroyed. That is the risk. That's why I say you have to beware. You have to go in eyes open, no matter how much you might, someone might think, well, they will beat expectations and raise the outlook for investors. Those things don't set stock prices. People and machines do, who buy and sell it. I wish financials set prices, but they don't. They're an input. They're just one input. So you have to be aware of that. That risk will exist. The good news is you could look at that and go, well, there are offsetting bets here, right at options expirations, short bets, right ahead of results, long bets. And who's going to win? How would you know? I don't know. And nothing in the math would tell us absolutely. One other maybe example here. DaVita, I think, had the same issue, something similar. And I'm just illustrating these to show you the risk. Well, at least here you would know probably what was going to happen. But again, do we know which bet is going to win? I'll say here at October options expirations, long bets were set in DaVita. But then ahead of results, short bets were set, and they were 71% short ahead of earnings. Whew, I will never touch that with a 10-foot pole, right? But still, you wouldn't know. You could say, well, they have very strong demand. Is it possible that the long bets back here are right? Well, man, it's just dangerous. That's why, once again, I'm just illustrating how could you know that there was risk that DaVita would collapse? Well, absolutely. There were bets that it would, but there were also bets the other way back here. I'm just trying to point out that it's the reason why you have to have a very clear head when you think about doing, pursuing earnings returns like that.
Can we take a look at First Solar, because it's one that's not working out for me, because I ignored the data. They reported horrible earnings, horrible guidance. And yet, so I'm still sticking with it, but yet you can see I ignored the data last Thursday because I had rising sentiment, right? Supply was kind of all right, not bad, but I ignored it where it said the probability of going the direction you want may not happen, because I was thinking down. It's been steadily climbing, but it's sentiment is at 10 and supply is rising. So at some point now, it's getting more predictive when it's going to come in, regardless of what the news says or what the market's doing, which I found was fascinating. A little bit painful, but fascinating.
Right. I'd look at that too and think, well, it's got rising demand, but supply is well over 50%. Now there's a downtrend. There is a downtrend in it, but it's well over 50%. So the probability that a rising demand will overpower that excess supply is minimal. It's minimal. And so you're right. It's an unusual outcome. where
You're in a
there's
market where mega caps like Apple are getting crushed, and First Solar is rising, and it's in the data.
right. Right. But I think you're right. These conditions will reverse. There's a high probability that demand's going to diminish, and with high supply, the price will move in your direction. You know, this would be a reason to, if you were long FSLR, I would be out on this because the supply is rising at the same time that demand is. I would take the gains, not the chances, and leave if I were trading this long. That's a good one, Barry. Thank you for sharing it. Okay. And I have a bunch of examples yet, but I'm going to have to weed them down a little bit. I did want to point out how well the math has been working. You know, just about anything one could point to has performed reasonably well. You know, and I'll show you, because I want to show you the difference between good, what I would call good divergences, and divergences that are not so good. And we'll do that next. But I looked at a long list of the things that I have been highlighting, and it's really the math. I mean, I just report on the math. And they've done well. You know, if you have a strong divergence between supply and demand, the probability that a stock like Chart Industries will rise is very high. Now, the moment those things begin to change, I don't love this curve. I don't have a term for it. But I see over, and we may have to study that, but I'll show you how I will pick that less often. Still, I mean, it performed very well. There was a steep drop off in the supply side and steady demand well above 5, and it delivered. And again, you should, take the gains. The moment these conditions start to deteriorate, you could say, well, couldn't I stay? Yeah, you could. I'll leave as soon as this rises above the trend, so you could stay. And I don't know, it might be doing pretty well today. But that and I've checked, went right down the line. Today the stocks like United Therapeutics, very nice performer, and it did just the right thing. It wasn't moving right at the open. Boy, you say, well, don't you like it to be down half the volatility? I prefer that. If you get that opportunity, use it. But it didn't jump right away. It was kind of flat. And look at this wonderful, look how strong the demand has been. It goes back most of the trailing 30 days there. That's just hit 10. And supply dropped right off. Probably is a little bit of a short squeeze. People who were short the stock, who were forced to cover, that's very likely to produce a gain. And you can have a pretty good idea by looking at the amount of volatility in the stock. So if it goes up that volatility, which is probably about 4%, then take that. And it's been a very nice performer. You could already take that gain and get ready for the next thing. And if you can repeat that over and over, boy, it's just a great way to make it work. EQIX, right, was another one. Quinix, that had just, really, to me, that's very good data. That where you can look at that, that's a surging demand, and supply that's moved in exactly the opposite fashion probably produces a return in any condition, no matter what's happening. And son of a gun, I think it was up like 7% today. It may have pulled back some, but that's what you're after. And all we're doing is stacking, the mathematical probability of a very basic economic principle that supply and demand set prices, and if they diverge, prices will rise. Converge, they will fall. Doesn't work every time. And you can say, well, why doesn't it? There are different motivations, and it can be stronger or weaker in different places. So just to finish this, let's go look at volatile tens. And this is exactly what I do. By the way, I mentioned financials. Just look at financials. Here's the supply side, the demand side. This is taking into account over 500 stocks. Passive money is the lead behavior. Boy, that is good data. It tells you that as the market probably begins to deteriorate again, I'm not saying it's going to happen immediately, that the financials will maybe outperformers. Going to volatile tens just to hit these good versus bad divergences. I'm not saying that that's the absolute best way to describe it, but I'll show you what I mean. So there are 7 in here, and not all of them are awesome. This downtrend will be the 30-day. That's the default in the portfolio view. We've left it that way because I still think the trend is good to see. But if you looked at Viva and you said, okay, well, how's the supply-demand equation there? that is not as good. I would look at this and say, that's a very nice demand trend. It's probably up today. The supply trend just returned to, the supply line returned to the trend line. And so that's still a divergence, but I'm going to look further. I look at that and say, well, it's not bad. If you bought this as a portfolio, you're probably up because it's all good stuff. But is that as good as is this protein to PL Prologis? That's who it is, real estate company. That's better. It's still not awesome because it didn't drop below trend, but still that's that's pretty good. I'd say, well, that would be ahead of Viva to me. And here's why I picked United Therapeutics. If you just compare these and say, well, you pull this up and you go, whoa, there you go. See, that's well below trend and a steep drop off, strong demand. That of the three, now I've got that's best. Prologis number 2, Viva number 3 out of those. And it's just looking at the degree to which those are occurring. And you could mathematically do that. I realize that. Could you run a calculation? Yeah, but there's a point where you've overanalyzed it, I think. Same thing here with Equinix, which, just look at that. You immediately see big supply deficit, very strong demand, probably that price moves. And so those two, I thought, well, those are really good. Now, how about this? I can't remember. There's Allegion, yeah. Okay, so that's an ADR too. But see here, this is not a great divergence to me. It's fine. It's 46%, so below the market level, but statistically it might have moved down. But that's of the lot, this is the weakest one. Will that demand carry the day? It might. I haven't looked at it to see if it rose, but it's not as strong as the other ones that we looked at. Raymond James Financial, I would say this is a pretty good one too, and it's in financials. You look at that and say, well, very strong demand. Supply just tailed us, still pretty high at 47%, but that's a good divergence. Any sector where we know there's excess demand, and there's a logical reason for that, of course. Interest rates go up. There's a probability that those who are in the loan business can do better. And then 5 below, I think, right? Retailer, yeah. So here, not as good. In fact, I'm not even sure why that shows up. It's a 5-day decline. That's what it is in volatile tens. But strong demand, very similar demand to United Therapeutics and Equinix. But this is not moving the direction that I would like. So I would put that, even though it's a big supply deficit, all of these stocks probably do well. But there are ones that you want the highest possible probability. So that's what we were aiming for. Okay.
Hey,
I
Tim,
have covered just about every. Yes, please, Barry, go ahead.
just a quick one on the volatile
Yeah.
tens. So every one of them is up from 1.13%. Equix is 1.13. This is from the open, and Vive is up 5.47. So yeah, it's been a good day for volatile tens, even with the market all in the red right now. Looking at
Right.
the CNBC here.
Right, that's the beautiful thing, and thank you for the note too, Barry, and thank you for pointing this out. It's not. Look, it's reinforcement that the math works, and the hardest part is making the decision. Do it, take the gains, repeat it. We tend to sit around and think about it. Well, is this the right time, and when do I do it? I'm a day behind. I bought Gilead. But it's doing great too. I bought that on a little dip because of that. I like to trade, volatility. But all this stuff works if you can be disciplined about doing it. And I bought that at 99 shares at the market because there's a 2-cent spread in Gilead. So I just put in 99 shares, 99 shares, and they fill instantly. I might split that difference, but a very good way to get, and you can get out the same way. I sold BKR at a very nice gain, and I had a lot of it, and I just kept selling it, 99 shares at the market, and it was a 1-cent spread, and I got the same price for the entire group. And so, because I know they have to, my broker is going to have to buy it from me, or they're going to route it to somebody. And they routed a lot of those to, there's a half or a tenth of a penny spread. If you've seen a trade execute at 4 decimal points, that's what it is. It's a high frequency trader crossing the spread and taking pieces of pennies, and that's how they make money. That's Citadel, Barry. That's what they do. They're very good at that. So anyway, that's I've covered everything that I want to cover, and we could take maybe 2 more questions and we'll wrap it up. What is the cutoff time for the data we see, Richard? The data process, I get a little notice when the final steps of the process complete, and it's usually a little after midnight Mountain Time when I get that notice. And it could be a little soon. It depends on the data feeds. We get data feeds sometimes stuff is not right on the money. If it's a heavy volume day, the exchanges from whom we buy that data, it takes them longer to process it. And so it all depends on when they process it. But my rule of thumb is by 2 a.m. Eastern Standard Time, or Eastern Time, whatever it is, it should be done. Yeah, pretty close. It could be 1 even. Yeah.
And so,
Tim,
yes. So as of today, what's your take on the supply and demand trends there? I mean, we see the data from yesterday, but what's a likely scenario based on your experience? Are we looking at the shorts covering now that it's taken a big dip? Are we looking at the sentiment maybe falling because of the overall sort of gloomy? What do the numbers tell us as of right now?
Yeah, well, so the probability, the probability, looking at broad sentiment, and we do this, we run data all the time to look at the probability of gains when broad sentiment is above certain levels. And until this month, when the broad sentiment is over 6.4, the probability, the mathematical central tendency is a 5% decline. So if I look at this, and say, what's the probability that the market continues to rise? It is a number approaching 0. It doesn't mean that it won't be lumpy. The market can be lumpy. I'm talking about what's the central tendency at this level. If we did what happened back here in August, maybe it goes 2 or 3 weeks where we are kind of doing this. It will depend on the supply side. If the supply side starts to move up, the market's going to roll over. That's my view. If it does not, the market will not roll over. It will slowly fade. That's what I expect. There will be plenty of opportunity for us as traders to trade. And how we'll know when these things change is, I'll tell you, this is what I do. First thing I look at is I want to know how many are in big and stable, because when the money starts to think that the market is dangerous, the global macros, the BlackRock's risk management system called Aladdin, they run that data on, it used to be about 17 trillion of assets. After the markets come down, maybe it's 12. But if that number all of a sudden jumps to 10, I know that there's a probability that volatility is coming, because everybody running models thinks it's coming. And so then there tends to be a concentration into those stocks. And conversely, I will look at the momentum, and I realize where I want to arrive is 2 things: a place to be when the markets are rough, and a place to be to outrun the market when it's not rough, so that we can take advantage of momentum opportunities. When this number comes down below 10 or vanishes, then I'll know that the volatility trade's over. If volatile tends, it's already weakening. 7, 7's okay. You drop to 3, the volatile trade's over. And then I'm going to be very careful about what I do there. That's what I'm looking at every day.
Okay, thank you.
Good? Okay. Great to see you guys. Let's do it again next week. Come back. We'll do it on whatever that date is. It's the 10th, I think. So I'll look forward to seeing you guys November 10th. And as soon as this processes, I'll make sure it's available. Post on the system message. If I don't forget, I'll put it in the PS in the market desk note. So good to see you guys. Thank you.
Thank you.
Thanks, Tim.